UBS fee for this ETF went from 30 basis points to 6. That's an 80% cut, and is now one of the cheapest MSCI World Equity trackers that you can buy. So in this video, I want to unpack what's behind that price drop and give you my opinion whether it's now a good time to switch into this fund, because if 6 basis points is becoming the new baseline, a lot of low-cost funds just became expensive. Let me explain. If you are already familiar with low-cost ETFs, you might be thinking of this Amundi ETF, which charges just 5 basis points for global equity exposure. So what's the big deal about 6 basis points here? Well, Amundi tracks a selective index, which is cheaper to license, while UBS tracks the MSCI World Index, which is more expensive to track. So, seeing only 1 basis point gap between these two is what really caught my attention. In one of my previous videos, which I will link here, I broke down Amundi's cost structure, and I found that its super low fees were likely a margin decision, because fund costs, they looked okay. So when I saw this UBS fund, my first assumption was, surely that's the same. They must be cutting margins aggressively. But even then, 6 basis points still feel very low. So for this video, I wanted to stress test that idea and see whether the numbers still held up. From 2022 to 2023, UBS cut just 1 basis point and assets barely moved. Then in 2024, they got aggressive. The fee dropped to 10 basis points. Naturally, flows accelerated. By 2025, 2 more cuts follow, and by the end of the year, the fund was almost hitting 10 billion AUM. That raises an obvious question. How much room did they have to cut in the first place if they could reduce the fee by 80% and scale the fund up? And more importantly, is there anything here we should actually be worried about? To answer that question, we need to step back a bit. So I looked at a research working paper called Why Index Funds Have Market Power. And the authors ask one simple question. If index funds offer near identical products like we see here and are relatively cheap to run, why do so many fund providers still charge high fees and manage to keep large AUM in the market? Well, their answer comes down to 3 forces. First, inertia. Most people, they just pick a fund and rarely they change even if there are cheaper alternatives. Second, search frictions. Even if you want to change, finding a new fund and switching takes effort, so people just don't bother. And third, there are personal preferences. People get familiar with brands, platforms, and they just become loyal to them. These 3 forces give index funds providers far more pricing power than you might expect. The researchers tried to quantify how large that pricing power actually was. So they collected expense ratios across a large sample of index funds over around 20 years up to 2020. And what they did is they reverse re-engineer the economics. In simple terms, they asked how much of that expense ratio is cost and how much is markup. And what they found is quite interesting. The average expense ratio for an equal weighted index fund over that period was 77 basis points. So they estimated a marginal cost of 14 basis points and an implied markup of 55 basis points. So about 71% of the expense ratio was markup. That's a lot for a product with massive economies of scale. Now, if we take the same logic and apply it to UBS's fee cuts, albeit the average expense ratio for an asset-weighted fund like UBS's is typically lower than the one for an equal-weighted fund, which is the one that they used for the study. The implied markup collapsed to around 14%. So UBS didn't find a cheaper way to track MSCI World Index. They just gave up a large amount of that embedded pricing power so they could scale up. So, is it time to switch to UBS? Well, in my opinion, once you get an MSCI World Tracker for 6 basis points, it becomes very hard to justify paying more for the same product. So what we're seeing across the market is a sign that that old pricing model for passive investing is shifting. As platforms improve, information spreads, and competition intensifies, that pricing power is drying up. So whether you switch to UBS or to another low-cost alternative, the lesson is the same. Don't assume your current fund is good enough just because it was cheap when you bought it.